Wall Street loves to worship the Magnificent Seven. But inside that group, there are three names that look messy right now. Their headlines are ugly. Their valuations feel all over the place. And the mainstream narrative keeps chanting, these are declining. Here's the twist. Those problem stocks are exactly what made me see a bigger pattern. A pattern that could turn into massive wealth creation over the next 10 years. Because underneath the noise, the financials are still shockingly strong, the tech trends are still accelerating. And some serious institutions are quietly adding, not fleeing. Most retail investors miss it because they only see the surface level data. They don't see the setup hiding inside the controversy. So today I'm going to clear the fog. We're breaking down the three most debated giants, the ones I believe have the strongest upside. We'll go from earnings quality to tech positioning, from short term valuation pressure to long term logic. And by the end, you'll have a clean framework to spot the next sleep well super horse for the next decade. And yes, this video is longer, but every section is my real back pocket investment thinking. So do me a favor, if you like deep practical breakdowns like this, hit subscribe right now because I post more of these and you don't want to miss the next one. And if you get value today, a quick helps a lot. Before we start, a serious note. Everything I'm sharing is based on public information and personal experience. It's subjective. This is not financial advice. Markets carry risk. Invest carefully. I'm Lynn. Let's begin. Today, we're reviewing three companies and how to think about positioning around them. And since we're in earnings season, this is the perfect moment to do it. These three names look flawed on the outside, but the potential hiding inside them is not small. Company one, Tesla. Let's start with the main character, Tesla. Among the seven giants, Tesla is easily the most dramatic one. I've been long-term bullish on Tesla, and I've traded in and out of it repeatedly over time. This stock has gone from the hundreds to the 400s, then pulled back hard. And through all that, I've kept Tesla on a very high alert watch list. Now, here's what I want you to notice. Recently, Tesla's stock has been quiet, and it's been rising quietly. And in markets, when something gets quiet, that can be dangerous because sometimes quiet means a major turning point is forming while nobody is paying attention. Most people are still asleep. But this is exactly the kind of window that decides whether you catch the next wave or watch it without you. So first, let's look at Tesla's latest earnings highlights. This quarter, Tesla reported revenue of $28 billion. That's up 12% year over year and up 24% quarter over quarter. And that number clearly beat expectations. Why was revenue strong? Two drivers. Cars performed extremely well, and energy continued to stay strong. Auto revenue came in at $21.2 billion. Deliveries were close to 500,000 vehicles, a new all-time high. Why did autos beat so hard? In my view, two reasons. First, demand momentum from the Model Y in China added fresh fuel. Tesla had been in a supply-tight, demand-strong situation there. Second, in the US, the EV tax credit tied to the Big America legislation was about to expire at the end of the third quarter. That created a pre-expiration buying wave, a rush that pulled sales forward and boosted Q3 results. Now the market's other obsession, margins. Gross margin was 14.7%, and it improved for the second straight quarter. Energy revenue hit $3.42 billion, up 44% year over year. And I've said this before, but it matters. You cannot value Tesla by only staring at car sales. Tesla's energy storage and its robotics direction are globally leading. But the most shocking part? Cash flow. Free cash flow hit a record high of $4 billion. That's close to 3 times the expectation. That matters because Tesla is spending heavily on AI. And there are even rumors about a potential acquisition of xAI. Strong cash flow supports confidence. It tells the market Tesla can fund big ambition without breaking the balance sheet. So at this point, many people think, okay, Tesla is perfect. The stock must rip to new highs. But if you truly understand Tesla, you know the stock isn't driven by one thing. It's driven by two tracks. Track one is fundamentals, revenue, profit, cash flow. Track two is the tech narrative, FSD, robotaxi, and the humanoid robot. Here's the real question. Which track matters more right now? Which one decides whether Tesla can do another 10x or even more? My answer is simple. Tech is the lead story. Fundamentals are the foundation. So why hasn't the market already exploded upward? Because the tech upside is enormous, but the payoff timeline is not immediate. Tesla's big ambition is aiming at one key time marker 2026. Yes, 2026. That's the year Tesla could truly break out. By 2026, FSDV 15 could be close to fully autonomous driving, and robotaxi is expected to become real in Austin with no driver operation. Austin's operating area has already expanded to 3 times what it was when it first launched. Cumulative driverless miles are over 250,000 miles, and safety driver testing miles have passed 1 million miles. Right now, the most important job isn't hype. It's proving the business model from 0 to 1, safely. If Tesla proves the model works, then scaling from 1 to 100 is mostly an execution game. Scale takes time, but the path becomes clearer. Now let's talk about Tesla's humanoid robot. By 2026, it's expected to enter small-scale production. And if you listen to the latest earnings call closely, you probably noticed something. Management spent a lot of time talking about the humanoid robot, and comparatively less time on FSD and level testing. That felt different. Because this time the robot didn't sound like a pure concept. For the first time, it sounded like an actual production plan. Musk said that by 2026 Q1, Tesla expects to show a new robot version, Optimus FAF 3, and begin preparing for mass production. The company's goal is to build a production line with annual capacity of 1 million units and start production by the end of 2026. That's not me inventing sci-fi. That's the timeline stated on the call. Now, short term, Tesla still has real challenges. Strong Q3 sales may have pulled demand forward, which can pressure Q4. Subsidies may decline. Full autonomy is still far away. Profits may be recovering, but costs are still heavy. And one huge uncertainty is whether Tesla can acquire xAI. So yes, 2026 could be Tesla's biggest year for a tech narrative breakthrough, but it's also the most critical year. In my opinion, after tracking Tesla for a long time, 2026 looks like the strongest year we've seen in the past 5 or 6 years. So here's the uncomfortable question. Are you willing to position while it's quiet, or do you want to chase after it takes off and regret not paying attention today? All right, that's Tesla. Company 2, Meta. Now let's talk about Meta. I made a deep dive report on Meta a few months ago, and after this earnings release, the stock saw a deep pullback. I'll say it clearly. Meta is a classic mispriced example. In my view, that's not an exaggeration. At its core, Meta is a money printing machine. Facebook, Instagram, and WhatsApp build one of the largest ad platforms on earth. The numbers are wild. Profit margin up to 80%, net profit margin around 40%. Think about that. If the business makes $100, about $40 goes straight into net profit. Over the past decade, net profit, free cash flow, and user growth all climbed hard. Annualized growth was around 30 to 40%. On paper, a story like that should be celebrated. But Meta has one word that keeps scaring the market. Metaverse. Zuckerberg made a massive bet on the metaverse. And the internet laughed. Burning cash, no one uses it. No one understands it. And if we're being honest, the reality is harsh. Even if the metaverse becomes commercial someday, asking normal people to wear a big headset all day is not realistic for everyday life. From 2021 to 2023, Meta's net profit and free cash flow fell sharply. The stock was crushed, a former king became a problem stock. But what most people missed is this. Meta climbed out of that hole, and it did it beautifully. Let's talk about the turning points. First, Meta's financial structure is extremely light. Its recovery speed is impressive. Meta hasn't relied heavily on borrowing. Before 2022, it was basically close to zero debt. Even now, it has liabilities, but short-term cash flow can cover them. It's hard to find another tech giant with a balance sheet this clean. And in 2023 and 2024, free cash flow and net profit rebounded rapidly. They essentially repaired back to pre-pandemic levels. But the true dividing line was strategic. Meta didn't stubbornly march into the metaverse with no exit. When monetization didn't show up, Meta quietly pivoted. It shifted towards smart glasses. A bet on what could be more revolutionary than the iPhone as an entry device. Reality Labs is no longer just a VR toy factory. It's a wager. Meta partnered with Ray-Ban on smart glasses, and it's already on the second generation. What can they do? Take photos, record video, translate, voice interaction, even integrate ChatGPT. Now imagine the future. What if you don't need to pull out your phone? What if you wear glasses and complete 90% of daily information tasks? That's the market Meta is betting on. But this bet is expensive. Reality Labs loses money year after year. Its latest operating margin is minus 800%. And unlike Google, Reality Labs is big enough to drag Meta's overall profitability. That creates a clean, high risk, high reward structure. If the smart glasses win, Meta could own the next iPhone level platform shift. If they fail, Meta will still be treated as a problem child of big tech. After the latest earnings, the scary stories came back fast. But my view hasn't changed. I remain long term bullish on Meta because Meta's risk and Meta's opportunity are the same thing. Now, as a normal investor, how do you think about valuation? Wall Street analysts are mostly bullish. Their target range for Meta is about $770 to $1,117. Meta's PE is around 2, and from a valuation angle, it's gotten more expensive. It's also up a lot compared to the beginning of the year. So, what's the real decision? If smart glasses fail, Meta can still live extremely well on social advertising. That cash flow is real. The foundation is solid. But if smart glasses succeed, Meta could become the next major human interaction terminal after the iPhone. And that's when the stock could enter its next takeoff phase. So the question becomes personal. Are you willing to bet before everyone fully understands it? Do you believe this tech narrative is a castle in the sky or a future that's being seriously undervalued? I won't force an answer on you. Tell me your view in the comments. Company 3, Amazon. Now, the last company is Amazon. A lot of people hear Amazon and think shopping, Prime subscriptions, global logistics. But most people don't realize what truly holds up Amazon's stock. Amazon is one of the rare giants with a true dual engine model. Engine 1 is e-commerce. Engine 2 is AWS, the world's largest cloud service. And the engine that truly prints profit is AWS. Let's zoom out. For the first 20 years of its 30-year story, Amazon barely made real money. The breakout happened mainly in the last 5, 6, 7 years. AWS has extremely high gross margin. It's the core profit source. E-commerce is massive in scale, but margins are not high. It functions more like a traffic entrance, a funnel. So Amazon's power is the combination. Front-end controls products and traffic, back-end controls enterprise computing infrastructure. That creates one of the widest moats in business. But the same structure comes with a problem. When it's good, it's incredible. When it's not, the market becomes nervous. This year, Amazon's stock has been choppy and sideways. Not because fundamentals collapsed, but because investors are questioning one thing. Can Amazon defend its cloud leadership in the AI era? Competition is aggressive. Microsoft and Google cloud growth rates are above 30%. Amazon's growth is 17.5%. So yes, Amazon is still the big brother in traditional cloud. But if it can't lead through the AI shift, the market may re-rate its valuation. So does Amazon have a counterattack? I believe it does. And it has more than one card. Card 1, its own AI chips. Many people don't know this. Amazon isn't only buying other companies' AI chips. It built a full internal stack. Train models on Amazon chips, run AI inference on Amazon chips. That vertical integration can make AI workloads faster, cheaper, and more stable. And it increases customer stickiness. Because if customers want to switch platforms later, the switching cost gets higher. Card 2, its satellite internet project. Amazon is rolling out its own satellite internet plan, and it wants to connect that to AWS. The goal is to bring the cloud to the most remote corners of Earth, meaning what? If you can see the sky, you can connect a village in Africa, autonomous devices deep in the mountains, remote medical systems, border security, agricultural AI. This isn't just Amazon shipping boxes. This is Amazon building the widest computing infrastructure on the planet. Card 3, its traditional e-commerce machine is recovering. During the pandemic, Amazon got hit with inventory issues and slow-moving goods. But now a lot of that has been resolved. Warehousing is regaining efficiency. Logistics are speeding up. Global fulfillment is picking up again. Amazon climbed out of the pandemic mud and stabilized the base. Now, valuation. Amazon's stock is around $240. Wall Street's average target is $290, roughly 20% upside. Among the 7 giants, Amazon sits in the more reasonable valuation tier, not a huge bubble. And analysts are broadly positive. So why isn't everyone screaming buy, buy, buy? My guess is simple. Amazon is massive. People assume it can't grow fast anymore. But let me challenge that. The companies that truly survive cycles and climb steadily are rarely the ones that spike every day. And inside the Magnificent Seven, the only one I'd label as a pure monster stock is Tesla. Because Tesla's personality is different. Amazon is the opposite. It climbs quietly, a slow bull, a long bull. And for patient, long term investors, that's often the better match. If the AI era truly accelerates, cloud demand will likely show up early and strongly in AWS. So today's price could be a mid game golden entry, not the end of the story. Tell me in the comments, do you think Amazon is worth adding here? How do you see Amazon's future? The final scoreboard. All right, now we answer the question everyone cares about. Is this a buy the dip moment? And are these three companies worth owning? If you're the kind of investor who likes long holding periods and believes tech revolutions can create 10x returns, here's the clean summary. Tesla, high risk, but explosive upside. Best for investors who understand position sizing and can read both fundamentals and technicals. This is a position early and accumulate in the valley type of name. The risk is volatility. The swings may not be small, so you manage the position carefully, but if the tech narrative delivers, the potential return is 5 to 10 times in the future. Amazon, very defensive, very stable growth. Great for steady investors. Its dual engine structure is resilient. Cloud plus satellite plus AI plus e-commerce gives it long-term compounding potential. A strong core holding style name. Meta, huge disagreement in the market. The direction is unclear. This fits a pressure-resistant investor. If you believe smart glasses will work, the upside could be massive. If you think it fails, the ad business still provides a strong foundation. My personal focus order, Tesla first, Meta second, and Amazon as the stable growth portion to manage the overall portfolio. But remember this, investing is not about predicting the future with certainty. It's about placing a bet on a higher probability future under uncertainty. There are no 100% guaranteed events here, only better setups and better position management. So today we broke down Tesla, Meta, and Amazon. Three problem stocks the market loves to argue about. They look controversial, but each one is standing at the door of the next wave. And here's what they share. They keep moving forward while being doubted. Sometimes the biggest opportunities are born when disagreement is the loudest. The market loves simple stories. But real wealth is often hidden inside complicated noise. These companies don't have no problems. Their problems are exactly where the 10x logic can hide. So now I'll leave you with a question. Out of these three, which one do you believe the most? Tesla, Meta, or Amazon? I read your comments, and I reply seriously. If you got value today, hit like. It's the biggest support you can give me. And going forward, I'll keep breaking down complex investment logic in the simplest way possible. I'm Lynn. See you in the next video.